Welcome to Markets Now. Ellen Brugler with Brugler Marketing joining us on a mixed close in both grain and livestock futures trade on Monday. Ellen, let's start off with the wheat market pushed higher here in part by China business. Will we see more business? And is this the kind of catalyst that could finally get the funds to get out of that short position they have in that market?
Well, I think there's definitely some further potential there. Not necessarily China. I think China's got good reasons for buying it here. SRW wheat is very competitive with other origins on the FOB market, the CIF market. So if they're buying wheat, the U.S. is a reasonable place to buy it, but it's only going to be SRW. The world supply numbers for wheat typically peak in July, August, September, because the bulk of the world's production's in the northern hemisphere. So we are in a declining supply situation all the way through next May, with a little exception for South America and Australia. So that helps prices. The funds have a very large short position. The three market combined fund short was record large. So they're starting to get underwater on those positions and they're wanting out. So I think there's room for further short covering here.
Just from a technical standpoint, though, we had key weekly reversals, and I think at least Chicago and Kansas City wheat. So technically, is there a case to be made for maybe shorts blowing out?
Yeah, we were very oversold on the oscillators, the RSIs, and the stochastics. As you mentioned, you've got some key reversals. You've taken out some of the moving average resistance on some of the daily charts. There's definitely some room there. I think the biggest problem is the last 10 or 12 rallies in wheat have all been kneecapped or cut off because of the just coming down off the 2022 highs, and the fact we've got a 9-year cycle low due in wheat in 2025. But that doesn't preclude rallies of $1 to $1.50, certainly, and even more than that if you can come up with a good excuse. So, and just a short covering could go a lot further than what we've seen so far.
So corn had a higher weekly close last week, and corn today kind of felt like it got stuck between wheat going higher and soybeans going lower. But if wheat keeps going higher, if you're friendly wheat, can corn keep following?
I think the wheat rally helps corn to the degree that you're buying the wheat for feed wheat, and we kind of suspect China might be doing that as much as it is, or to substitute because some of their wheat was not good quality last summer and they end up feeding that. That doesn't help corn, but they might be buying wheat instead of buying corn. But the flip side of that is, feed grains in general tend to correlate. They tend to track together. Corn's going to tend to lag a little bit because of that 2.1 billion bushel carryout estimate we've got for U.S. corn. Historically, that would be $3.50 to $4 corn. And, that's where we'll go over time if we don't cure that problem. So then that could be 2 years. Don't take me wrong. I'm not saying soon. But what I do like is you saw the spreads go out to full carry there last week. That basically told everybody, don't sell corn now, hedge it against March. That starts to have basis impacts. And, again, the answer to your question is yes, the higher wheat, given the setup in corn, is probably helpful to corn.
Yeah, but like you said, when you get that big of an ending stocks figure, it's going to be a headwind. Although exports have picked up, demand has picked up a bit here overall, has it not?
Yeah, export inspections were very good for last week. Year to date, export inspections are up 24% year over year. Now, keep in mind that was a very bad year last year because of price rationing. We're actually tracking fairly close, plus or minus 20 million bushels with USDA's forecast year to date, as far as what percentage of the full year total have we met. So we're on track with the current USDA forecast. The strong inspections don't tell me that USDA needs to make any changes on Friday in their export number. But again, nice export inspections. We are pretty dependent on Mexico right now. We'd like to see that broaden out, but of course we know the problem, and the problem is the Panama Canal. most of your Asian business is either got to go PNW, which has got some capacity constraints, or if you're going out of the Gulf, you've got to go all the way around Africa or all the way around South America in order to go to Asia. So that's complicating things a little bit, and has been a basis problem as well.
Soybeans setback here today. The meal market setback as well. But soybeans, did we just take out some Brazilian weather premium today, you think?
I think that's the big part of it. You're seeing Brazilian planting progress is advancing. I believe one of the firms had 85% complete today versus last year's fast pace of 91%. So they're actually not very far off of the 5-year average pace for planting. Yes, you took off some of the early maturities, and that's going to nick your yields and your overall production, I think. But yeah, the weather's improving in the center west area, which is the biggest production area. You're starting to see more rains there. There was fairly rapid planting progress in Rio Grande do Sul last week, which was an area that had been struggling with too wet conditions. Argentina seems to be in fairly good shape, still dry as far as their overall moisture accumulations. But again, yeah, you're taking some weather premium out here. And the export inspections weren't very good for last week either.
Plus, we hit some chart resistance again. And so technically, that market doesn't look as good as it had, right?
No, we broke the uptrend line going back to the June lows on the January futures here. We've got a sort of a negative sloped head and shoulders top on the Jan chart, and we broke below the neckline today. There were some things you didn't like here. The only positive from a technical standpoint is you got oversold, and that's setting you up potentially for a turnaround Tuesday bounce or a late week bounce at least.
So Monday live cattle futures hitting some more new lows for the move feeders, some new contract lows there. We've had a big correction, but how much lower do you think we have to go here?
Well, if you look at the feeders and you look at a monthly chart, the 38% retracement, which is normally what you need to get all the winners out, in this case the longs, that's $198. So that's still a ways down, and that's one of the conundrums here is that the weekly and monthly charts are still showing large gains over the last 2 years, and this correction on those charts doesn't look that major. But then if you look at the daily chart, you're hitting new life of contract lows, and you're saying, wow, this is ugly. What we know is that the market's a little bit nervous about consumer demand. The economic signals are kind of mixed. It's slowing down. It's not slowing down. The Fed's going to have to raise rates. They're not going to raise rates. We're biased not to raise rates from the Fed. We don't think they're going to need to do that. But that's been being built into the market, along with the fact that we've got very high carcass weights, and we're getting more beef production in this time in this quarter than we had anticipated 6 months ago. The other aspect of that, of course, is the funds are just heavy longs. They're trying to get out of those longs and pare back the position a little bit. And that's the shorts are in no hurry to let them out. I would point out that we're still in the liquidation phase of the cattle cycle. So this is not a terminal illness necessarily. It's more of a money flow thing.
Yeah. Commitment of Traders report was out on Friday, though. And are the funds just about out of that long position or not?
Well, they've diminished it quite a bit here. Of course, that's only as of last Tuesday. So there's a little bit of price action it doesn't explain, but they definitely have unwound quite a bit of those positions.
Let's talk about the macros. Gold hitting record highs. And in the meantime, you had the dollar pulling back here a little bit today. But are these indicators that the market feels that we're not going to see another rate hike or that we're going to see rate cuts? And doesn't that fly in the face of what Chairman Powell said last week?
Well, you've got gold, as you point out. Gold has gone to new highs for the move, and you also saw the Bitcoin, which trades like a currency or like gold, depending on who you talk to. It hit $40,000. So those are both sort of weak dollar inflation indicators. The dollar had been declining. It had hit the lowest reading since, I believe, August. and then bounced hard on Friday and gave part of it back today, Monday. So, yeah, the dollar weakness is tied to interest rate expectations. Okay, if one of the reasons for buying dollars was the interest rates are higher, stronger in the United States than in other countries, then you sell those currencies and buy dollars. If you think the U.S. rates are starting to come down, either from Fed action or just plain old market demand, that makes the dollar a little less attractive. A weaker dollar is helpful for commodity prices, gold being the poster child there right now at the moment. The thing you have to remember is the dollar typically is only going to move 4 or 5% per year, whereas commodity prices can swing 15 or 20% just on yield variance. So it's not the be all and end all as far as ag prices, but a weaker dollar and or inflation in some of those commodity prices would be positive for ag.
Yeah. Great analysis as always. Thanks for joining us, Alan Brugler with Brugler Marketing. That is Marketing Markets Now.